There is a list sitting on a server inside every major UK lender right now that no borrower is ever shown, no estate agent will confirm exists on the record, and no regulator has forced into the open. A list of postcodes, streets, and in some cases entire buildings that a bank has quietly decided it will not lend against under any circumstances, regardless of your income, your deposit, or your credit history. Not a public register, not a website you can search, an internal risk file built from claims data, valuation history, and building safety records that decides, before you have even filled out a mortgage application, whether your dream home is bankable at all. I have been tracking the UK property and mortgage market for years, and this is one of the least discussed forces currently reshaping who can buy, who can sell, and who is quietly trapped. In the next few minutes, I'm going to walk you through how these lists actually work, why they exist, what puts a building or a postcode onto one, and what you can do if you suspect yours already is. Let's start with what this actually is, because the word blacklist makes it sound more dramatic and more organized than the reality, and understanding the real mechanism matters if you want to protect yourself. Lenders do not maintain a single shared industry-wide blacklist in the way people imagine, a literal document titled "Do Not Lend Here" circulated between banks. What they maintain instead is something arguably more powerful, because it operates quietly and individually. Each major lender runs its own internal risk engine, a system that scores postcodes, individual buildings, and sometimes entire developments based on a combination of factors: claims history, flood risk data, subsidence records, building safety status, insurance availability, and crucially, the lender's own accumulated experience of properties in that location that have previously caused problems, whether that is properties that would not sell at valuation, properties tied up in cladding disputes, or properties where a previous loan went into arrears or default. When enough negative signals accumulate against a specific postcode or building, that location's risk score crosses an internal threshold, and the lender's underwriting system will decline to lend there, or will lend only on significantly restricted terms, regardless of the individual applicant's own financial strength. Here's why this matters so much more than people realize. A borrower with an excellent income, a large deposit, and a spotless credit history can be declined a mortgage not because of anything about them personally, but purely because of the address they are trying to buy. And because this system operates at the level of individual lenders rather than as a public register, a borrower can be declined by one bank, have no idea why, apply to a second bank with no explanation of the previous refusal, and be declined again, often burning weeks of time and in some cases non-refundable valuation fees before anyone involved in the transaction, including their own broker, fully understands that the property itself is the obstacle rather than the applicant. Estate agents describe this exact pattern repeatedly: a sale that looked straightforward on paper, a buyer with a strong deposit and a clean credit history collapsing weeks into the process for reasons that on the surface appear to make no sense at all, until someone finally traces the problem back to the address rather than the buyer. To understand why this system has become so entrenched, it helps to look at how differently the same property can be treated by two lenders sitting almost side by side on the same high street. One lender might approve a mortgage on a flat within days at a competitive rate, while a second lender, presented with an almost identical application on the very same property, declines it outright or offers only a heavily restricted product. Borrowers naturally assume this difference reflects something about their own application, their income multiple, their credit file, their deposit size. Often, it reflects nothing of the sort. It reflects two different internal risk engines, built on two different sets of historical claims and valuation data, arriving at two different conclusions about the same physical address. This is precisely why brokers who work across the whole of the market, rather than borrowers going direct to a single familiar high street name, are able to secure mortgages that would otherwise have looked impossible, not because they have found a loophole, but because they know which lender's risk engine currently treats that specific postcode more favorably. Red flag number 1: cladding and fire safety status. This is the single biggest driver of postcode and building-level lending restrictions in the UK right now, and it has been for several years following the wave of building safety concerns that emerged after Grenfell. Any building over a certain height, and increasingly buildings below that height too, where fire safety documentation is incomplete, disputed, or where remediation work is ongoing or unfunded, is treated by most major lenders as effectively unmortgageable until an acceptable form of certification is produced. The building safety regulator has an enormous backlog of live cases, and every single one of those buildings, while its case remains open, sits in a form of lending limbo. If you are trying to buy in a building caught in that backlog, it does not matter how strong your application is, the building itself is the blockage. Red flag number 2, insurance availability. This one connects directly to something I have covered before on this channel. If a building cannot obtain buildings insurance at a reasonable premium, or in the worst cases cannot obtain insurance at all, it becomes immediately unmortgageable, because every mortgage lender requires adequate buildings insurance as a condition of the loan. Insurers have been progressively narrowing what they are willing to cover, particularly for buildings with any cladding history, and as more postcodes and buildings get reclassified as high risk by the insurance industry, the same postcodes and buildings quietly drop off the list of places most lenders will touch. This creates a genuinely brutal chain reaction. No insurer willing to quote means no lender willing to lend, means no buyer able to complete, means the existing owners in that building are trapped, unable to sell, watching their equity become theoretical rather than real. This is arguably the cruelest version of the mechanism running through this entire video, because it can happen to an owner who has never missed a payment, never had a single dispute with a neighbor, and never done anything other than buy a flat in a building that years later an insurer decided it no longer wanted on its books. There is often no single decision the owner could have made differently. The building simply moved through no fault of any individual leaseholder from one side of an invisible insurability line to the other, and every financial consequence that follows from that shift lands on the people who happen to live there. Red flag number 3, developer and management company reputation. This is one of the least discussed mechanisms and one that catches a lot of buyers completely by surprise. Some lenders maintain informal, and in some cases quite formal, internal flags against specific developers or specific managing agents based on that lender's accumulated experience of problems with previous developments by the same developer or managed by the same agent. If a particular developer has a track record of buildings that later developed cladding issues, structural defects, or persistent service charge disputes, some lenders will apply additional scrutiny or, in the more severe cases, outright declines to any new development from that same developer, even a brand new building with no issues of its own yet, purely on the basis of the name attached to it. The same logic applies to managing agents with a poor track record of building maintenance, insurance procurement, or financial transparency. A perfectly sound flat in a perfectly sound building can become significantly harder to mortgage simply because the name on the service charge invoice has a bad reputation inside a specific lender's risk department. Red flag number 4, flood risk and subsidence data. This is less specific to flats and more relevant to houses, but it belongs on this list because it operates through exactly the same hidden mechanism. Lenders increasingly use detailed, granular flood risk mapping, sometimes down to individual street level rather than broad postcode level, to assess mortgage risk. A property can sit on one side of a street with no flood risk flag at all, and a property on the opposite side of the same street, closer to a watercourse or on slightly lower ground, can carry a meaningfully different risk score. The same applies to subsidence, particularly in areas with clay soil that has been affected by recent dry summers, a growing concern as weather patterns shift. Sellers on the affected side of these invisible lines often have no idea their property carries a flag at all until a buyer's mortgage application unexpectedly stalls or is declined, at which point the seller is left trying to explain a problem they did not know existed and cannot easily fix. Red flag number 5, and this is the one closest to pure financial engineering rather than physical risk: previous non-performing loan concentration. If a lender has previously written a meaningful number of mortgages in a specific postcode or development that subsequently went into arrears, negative equity, or default, that lender's own internal data will flag that postcode as elevated risk for future lending, independent of whatever caused those earlier problems. This is a self-reinforcing mechanism. A postcode that experiences a wave of financial distress for whatever underlying reason, a local employer closing, a wider economic downturn, a specific building's problems spilling into the surrounding market, becomes harder to get a mortgage on for years afterward, purely because of that lender's own historical experience there, which in turn makes it harder for prices in that postcode to recover because a shrinking pool of buyers can actually obtain financing to purchase there at all. Red flag number 6, the professional indemnity insurance pullback among conveyancing solicitors, which I touched on in a previous video but deserves fuller treatment here because it interacts directly with these postcode level restrictions. As I've covered before, conveyancing solicitors are increasingly declining to act on leasehold flat purchases in higher-risk buildings and postcodes because their own professional indemnity insurers are pushing back against the litigation risk. This means that even in the rare case where a buyer does find a lender willing to lend against a flagged postcode, they can then struggle to find a solicitor willing to handle the transaction at all, adding a second, largely invisible layer of restriction stacked directly on top of the lending restriction. Some conveyancing firms have gone as far as publishing internal guidance to their own staff, listing categories of building they will no longer take on. A mirror image on the legal side of exactly the same risk aversion driving the lending restrictions themselves, which means a buyer can occasionally find willing finance and still struggle to complete simply because nobody in the local area is prepared to act as their solicitor.
Red flag number 7, and this is one that has grown sharply in relevance over the last couple of years: energy performance and retrofit risk. As lenders increasingly factor a property's energy performance certificate rating into their long-term risk models, partly in anticipation of future regulatory tightening around minimum energy efficiency standards for rented and mortgaged properties, older buildings with poor ratings and no clear, affordable retrofit path are starting to attract additional scrutiny. A Victorian terrace with solid walls and no realistic route to a good energy rating without extremely expensive intervention is increasingly treated differently from a long-term risk perspective than a comparable property with a clearer upgrade path. This is still an emerging factor rather than a fully established one, but brokers report it is already showing up in some lenders' internal criteria, particularly for buy-to-let applications, and it is widely expected to expand into standard residential lending criteria over the next few years, as regulation around minimum energy standards continues to firm up. Red flag number 8, short lease exposure compounding with everything else on this list. A flat with a lease under 80 years remaining already faces well-known mortgage restrictions on its own because most lenders apply minimum lease length requirements both at the point of the mortgage term ending and often an additional buffer beyond that. What is less widely understood is how a short lease interacts with every other factor already discussed. A short lease in a building that also carries a cladding flag or sits in a postcode with a flood risk marker does not simply add these risks together in a borrower's favor or against it in a simple additive way. Lenders' internal scoring models tend to compound these factors, meaning a property with 2 or 3 moderate risk flags can end up scoring as effectively unmortgageable, even though any single one of those flags in isolation might only have resulted in a modestly worse interest rate rather than an outright decline. This compounding effect is precisely why 2 seemingly similar flats, one with a single risk factor and one with several overlapping ones, can have wildly different experiences at the mortgage stage, despite looking almost identical to an untrained eye.
Now here is the part that connects all of these together, and it is the part that almost nobody in the property media is willing to say plainly. These postcode and building level restrictions are not really about individual buildings being unsafe or individual borrowers being poor credit risks. They are about lenders managing aggregate portfolio risk across their entire mortgage book, using whatever granular data they can get their hands on, and being willing to sacrifice individual transactions, individual sellers, and individual buyers in service of that aggregate goal. From a bank's perspective, this is entirely rational risk management. From the perspective of an ordinary homeowner who bought in good faith years ago in a building that seemed perfectly normal at the time and now finds their own lender unwilling to remortgage them, or finds that no other lender will touch a buyer for their flat, it looks and feels exactly like being blacklisted, because functionally that is precisely what it is. I spoke with a mortgage broker who has been placing residential mortgages for well over a decade, and off the record, she confirmed that brokers develop their own working knowledge of which lenders currently avoid which postcodes and developments, built up almost entirely through repeated, painful trial and error, declined applications, wasted valuation fees, and comparing notes informally with other brokers, rather than through any official disclosure from the lenders themselves. She described maintaining her own private spreadsheet, updated constantly, tracking which developments and postcodes have recently caused problems with which specific lenders, precisely because there is no official source she can consult instead. instead. She said the frustrating part of her job is that a restriction can appear or disappear from a lender's internal risk model with essentially no public announcement, meaning her spreadsheet is permanently a few weeks or months out of date, and the only way she finds out a lender has quietly added a new postcode to its restricted list is when a client's application inexplicably stalls or gets declined without a clear reason attached. She also made a point I had not fully appreciated before speaking with her, which is that these restrictions are rarely permanent in either direction. A postcode or building can drop off a lender's restricted list just as quietly as it appeared on it, sometimes within months, if remediation work completes, if an insurer reclassifies the risk, or if a lender's own internal risk appetite simply shifts as market conditions change. That means a property declined by every lender a broker approached 18 months ago can in principle become financeable again without any obvious external announcement, which is precisely why brokers with genuinely current, frequently refreshed knowledge of the market are worth more in this environment than a borrower simply relying on what they read online or what a friend experienced a year or two earlier. She described one case where a client's flat had been declined by 4 separate lenders over the course of a single stressful month, only for a 5th lender to approve it without hesitation weeks later, because that particular lender had recently revised its internal risk model for the postcode, following updated flood defense work completed nearby, information that was not publicly announced anywhere a borrower could reasonably have found it themselves.
So, what can you actually do about this, whether you are buying, selling, or already own in a flagged area? First, if you are buying, and particularly if you are buying a flat in a larger development or a postcode with any history of flooding, subsidence, or building safety issues, ask your broker directly and early, before you fall in love with a specific property, whether they are aware of any lender restrictions on that building, that development, or that immediate postcode. A good broker will often know or know how to find out quickly, and this single question can save you weeks of wasted time and application fees. Second, request an automated valuation model check or an early desktop valuation indication from your broker before committing to a full mortgage application wherever possible, because this can sometimes surface red flags before you have paid for a full physical valuation. Third, if you are selling and your sale keeps stalling at the mortgage stage for reasons that seem to have nothing to do with your specific buyer's financial position, consider that the building or postcode itself may be the underlying issue, and start proactively gathering documentation, building safety certificates, insurance confirmation letters, evidence of any completed remediation work that you can hand directly to a buyer's broker to help them find a lender willing to proceed. Fourth, if you already own in a postcode or building you suspect may be flagged, do not wait until you need to sell or remortgage to find out. Ask your own current lender directly, in writing, whether there are any restrictions currently applied to your building or postcode, because a written answer now gives you time to address the underlying issue, whether that is chasing outstanding building safety paperwork or querying an outdated flood risk classification well before you are under time pressure. Fifth, join or help form a residents association if your building does not already have one, because collectively commissioned reports, whether that is a structural survey, a fire safety assessment, or a formal flood risk reassessment, carry significantly more weight with lenders and insurers than anything an individual leaseholder can commission alone. And the cost split across an entire building is manageable in a way that an individual commissioning the same report alone often is not. Sixth, if you are working with a broker, ask specifically how many lenders they searched before coming back with a decline or a restricted offer, and ask them to be transparent about whether the issue sits with your own application or with the property itself, because a broker who works across a genuinely wide panel of lenders, rather than a narrow shortlist of familiar names, is statistically far more likely to find the one lender whose current risk model treats your specific address favourably, even when several others have already said no. Seventh, keep a personal file, physical or digital, of every piece of documentation relevant to your building's safety, insurance and management, updated as new certificates or reports become available. Because when the moment comes that you do need to sell or remortgage, having that evidence ready and organised, rather than scrambling to request it from a managing agent under time pressure, can meaningfully shorten what is often the single biggest source of delay in these transactions.
Here is how I expect this to develop over the next few years. As building safety remediation slowly works through its enormous backlog, expect some previously restricted buildings to come off lenders' informal restricted lists, but expect that process to be slow, uneven, and almost entirely undocumented from the outside, meaning individual owners will likely have no reliable way to know their building's status is improved until they actually test the market with an application. At the same time, expect the flood risk and subsidence side of this to expand rather than contract, as insurers and lenders both continue refining increasingly granular, increasingly street-level risk data in response to genuinely shifting weather patterns, which means a wide range of ordinary houses, not just flats in problem developments, are likely to find themselves newly caught by these restrictions over time, even in areas that have never previously been considered high risk. And expect continued pressure from consumer groups and some parliamentarians for greater transparency in this area, potentially including proposals that would require lenders to disclose more clearly when a decline is driven by property-level risk factors rather than the applicant's own financial circumstances, though based on how slowly comparable transparency reforms have moved through the system in other parts of this market, meaningful change here is likely still years away rather than months. It is also worth watching how the major credit reference and property data agencies respond to this over time, because several are already exploring commercial products designed to give buyers and brokers earlier visibility into building-level and postcode-level risk factors, essentially attempting to build the transparent version of the tool lenders currently keep entirely to themselves. Whether those products become genuinely useful, affordable, and widely adopted, or whether they remain a niche tool used mainly by professional brokers rather than ordinary buyers, will likely shape how much of this problem remains hidden versus visible over the next several years. There is also a slower-moving structural shift worth flagging here, which is the gradual move toward common hold as the default tenure for new flats, a reform I have touched on in earlier videos. In principle, common hold removes the freeholder from the equation entirely for future developments, which should, over time, remove one entire category of risk that currently feeds into these postcode and building-level restrictions. Since there would be no external freeholder relationship, no managing agent appointed by a distant investor, and no ground rent income stream creating misaligned incentives. That said, common hold, as currently proposed, would apply overwhelmingly to new developments going forward, and does very little, at least in its current form, to help the millions of existing leaseholders already sitting inside buildings and postcodes that carry one or more of the risk flags covered in this video. For this generation of leaseholders, the practical reality is that these invisible lender-level restrictions are a feature of the market they are going to have to actively navigate, rather than a problem likely to be resolved on their behalf within a useful time frame. The uncomfortable truth underneath all of this is that the property you already own, or the property you are about to buy, is being continuously and invisibly rescored by systems you cannot see, using data you are not shown against criteria that are never published. You can do everything right, save diligently for your deposit, protect your credit score, choose a property you can genuinely afford, and still find yourself unable to get a mortgage or unable to sell to someone who can, for reasons that have nothing to do with you personally and everything to do with an address, a developer's name, or a managing agent's reputation. If there is one action to take away from this video, it is this. Do not assume that because your mortgage payments are up to date and your finances are in order, your position is automatically secure. Ask the direct, specific questions of your broker, your lender, and your building's management company about safety certification, insurance status, and any known lending restrictions, well before you need the answer under pressure. In a market where the real blacklist is invisible until the exact moment it affects you, being the person who asked early is very often the difference between a smooth transaction and a stalled one. None of what I have described in this video requires a change in the law to protect yourself against it today. It requires treating your address with the same seriousness lenders already treat it.
gathering the paperwork before you are asked for it, asking direct questions of brokers and management companies rather than assuming no news is good news, and understanding that a clean mortgage history and a strong income are necessary but not on their own sufficient in a market where the property itself now carries its own separate, largely invisible credit file. The borrowers who navigate this well over the next few years will not be the ones who got lucky with their choice of postcode. They will be the ones who took the time to find out, early and directly, exactly where their own building and their own street currently sit inside a system that was never designed to tell them.